Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about pensions, and we have had a lot of fun stuff. We've gotten to do a journal entry. We've been doing tables all over the place. We've gotten to draw some pictures and T accounts. We've talked about what pensions are and why they're important and how we use them and the different kinds. It's been great stuff. Now we get to continue that discussion by talking about the other method of amortizing away our accumulated other comprehensive income. In our last segment, we wrapped up with a discussion of amortizing away the prior service costs. And please remember, every single time you see a prior service cost balance in that accumulated other comprehensive income, you are going to see amortization of that prior service cost balance in the current year. So if it's got a balance, it's going to be amortized. Now, though, we get to talk about the other amortization, and it only happens when necessary. And that is where corridor smoothing comes in. Now, the best way to understand corridor smoothing is with a picture. So let me show you FASB's logic. First off, here's our timeline, and we're going to say this is 0. The idea behind corridor smoothing comes back to our expected versus our actual returns. FASB assumes that over time, some years will be high, some years will be low, but we'll just kind of bounce around right around 0. Again, our expected returns we think will be higher than they should, so that'll bump that number up. Some years will show it lower than we should, and actual returns will be higher, and that'll drop it back down. But the idea is that we'll bounce around 0. But sometimes companies take advantage of this opportunity, and we showed that a little bit before. What we see sometimes is companies that just keep going up because they're using higher and higher expected returns, and they just keep showing these great gains and reducing their pension expense. Alternatively, you get companies that are doing the opposite, and they let that number get really, really small, big credits, because they're showing expected returns much smaller than their actual returns. So either way, FASB doesn't want to allow companies free rein to just choose an estimated percentage willy-nilly and not worry about it. So what they came up with was a check figure, a set of values that would keep companies from manipulating these numbers. And we call it the corridor. So what they said was, take your projected benefit obligation and your plan assets and multiply by 10%. And then we'll take the larger of these two, and that will be our corridor. So let's say we had a PBO of 2,000 and plan assets of 1,800. So I multiply both of them by 10%. I get 200 here and 180 here. I use the larger value. So what we would do is we would draw a line at positive 200 and negative 200. Now, as long as you bounce around within the corridor, you don't have to do any kind of an amortization. You don't have to change it, you don't have to tweak it, nothing. You just leave it be. Once you get up here, then you have to make an adjustment to bring it down. And same thing if you get down here, we bring it back up. That's what corridor smoothing is. So what happens is every single period that you have a balance in accumulated OCI gains and losses, you will do a check to make sure they're within the corridor value for that year. As our plan assets grow bigger or our pension obligation drops, then that corridor changes in size. So every year we do a check. If we're within the corridor, we move on. If we're outside the corridor, then we have to do some amortizing. So let's take a look at what the amortization looks like. So first things first, you take your beginning balance of the benefit obligation and the plan assets, you multiply by 10%. You then sum up the beginning balance of all the accumulated OCI accounts related to pensions. Now, in our worksheet, we've only used one other accumulated other comprehensive income account, but some companies will break it down into 2 or 3 accounts. So you have to add them all up, except for prior service cost. We're going to leave prior service cost out because it's being amortized on its own already, like we talked about in our last segment. So you add up everything except prior service cost. In our examples, that's just the one number. There's really no adding to do, but just be aware, if companies have split it up, you got to bring it back together. If that total accumulated OCI is greater than that maximum 10%. So we're outside the corridor. We're in these ranges. Then we have to do some smoothing. And the way we do that, first off, is we get the difference between the two. So that means we calculate this value or this value. Once we have those values, we then divide that difference by the average remaining service life of all of our active employees, meaning the people who are part of getting this particular pension. And to get that number, we take the total service years remaining, which we calculated last time, and we divide by the number of employees working this year. And that's going to give us our average remaining service life. Once we have that division done, we've taken the difference from step 3, divided it by that average remaining service life of active employees. That's the amount that we amortize out of accumulated other comprehensive income and record it as part of our pension expense. Again, this makes more sense if we do an example. So let's take a look at one. This is our ROS 1 company again. They reported a PBO of $1 million, plan assets of $800,000. In addition, accumulated OCI has a balance of $135,000. We want to know how much ROS 1 needs to amortize because of corridor smoothing. If they even need to, we need to check and find out. We had pension benefit obligation of $1 million, and I'm going to abbreviate again by thousands just because it's hard to write in these boxes. And then we had $800,000 for our plan assets. We multiplied them by 10, so 180, and the maximum value is 100. So if we were to draw out our corridor, there's 0, we're at 100, and negative 100. As long as we're within this range, we're good to go. Our beginning balance of our accumulated OCI was 135,000, which means we're up here. We're outside the corridor, which means that we have to do some smoothing. So how do we do that? Well, we start out by getting this difference. So 135 down to 100 is 35,000. Again, I'm abbreviating. Next, I need my average remaining service life of my active employees. If you're not already doing your prior service costs, then you got to go back and do the calculation tables that we did before. Luckily for us, we've already done them. So let's go back and take a look at those tables. So we have in year 3 a total remaining service life of 1,115 years. And in year 3, we have 200 employees working for us. So for this year, we take the 1,115 divided by the 200. So total remaining service life, that's 1,115. And we're going to divide by the number of active employees, meaning the ones that haven't retired yet. And again, I'm going to round to the nearest penny for this calculation, and I get 5.58, and that number comes right up here. And now I'm going to divide. I'm going to take the 35,000 divided by the 5.58, and I'm going to get, let's see, 35,000. I'll get it outside of the boxes here so I can write it out. It gives me 6,272, which, putting it back in here, we'll just make that a 6,000 as we round. And again, if you're going to round it, you have to be really careful that the rounding comes out right by the time you're done, etc. But that's the adjustment that we would need to make. We would drop it from the 135. We're going to bring it down $6,000. Now, how do we do that? Well, let's take a look at our worksheet and see how this goes in. Remember that we had an actuarial gain or loss of 135. We have a PBO of 1,000. We have plan assets of 800, which means we have a net pension obligation credit of $200. So there's our beginning balance. We're going to amortize away some of this 135. We said we were going to get rid of 6,000. So let's see, 6,000 down here. Now, if I want to drop this 135, it's got a debit balance, so I would need to credit it to drop it. Now that I've got a credit in that line, I have to have a debit to go with it. And And since we're amortizing it away like a depreciation expense or amortization expense anywhere else in GAAP, it affects my expenses. So I show that over here in this column. Now, if my actual gains and losses were down below and I had a credit of 120, then I would be debiting here and I'd end up with a credit in pension expense. I haven't been recording enough profit in earlier years because I've kept my expected returns too low. Now I've got this huge number that's just kind of built up. I've got to bring it back. I'll debit the actuarial gain and loss and I'll credit my pension expense. All right, while we're here, let's just wrap this up. We did also for ROS 1, and I'll label this up here. This is my ROS 1 example for year 3. So for ROS 1, the other thing we did were our prior service costs. If you remember from our last segment, we added 200,000. So 200,000 increase to our obligation. So I have a debit over here. If I'm going to get rid of that, I've got to credit it away. So we calculated that that would be 36,000. Credit here, debit there. And again, these are thousands. And that's how I'd put it into my worksheet and have it ready to go. And this right here is step 4. Now I'm going to pause right here for just a second. Understanding corridor smoothing, how it works and why we do it to snap back those numbers that have gotten too big because we've been a little loose with our estimates. That's another of our key concepts for pensions. You've got to understand why we do it and how. So make sure you're comfortable with that. Now that we have done all of the different pieces, it's time to bring all of this fun stuff together. And that's where we're headed next time. I'll see you then. Thanks.